Welcome to Roaming Returns, a podcast about generating a passive income with dividend stocks so you can secure your finances and liberate your life. All right, listen up. 2 weeks ago, we basically begged you not to panic sell during this market dumpster fire. Today, we'll do one better and tell you what's a great buy right now, even in the middle of this chaos. We've screened hundreds of dividend stocks, REITs, CEFs, BDCs, you name it, to find the good stuff. We're talking solid value, not just price drops. If you got cash or dividends to invest, this episode is all about how to uncover the gold while avoiding garbage with red flags. Not only do we show you our process and walk you through examples, but we've got 12 strong buys plus 16 tickers for your watch list so you can pounce when the timing's right. This is how you invest while the rest of the market's losing its mind. So this week's episode is about, I don't know, what did you decide to do?
It's all about value.
Value? What do you mean?
So what I did is through my emails that I got, and then through Reddit threads and through just doing like what stocks are valuable right now because the market did just tank. So I just said what's value. I came up with a list of probably 200 stocks, and then we put them into valuations. We'll walk you through a couple of them so you can see how exactly I do it. I mean, now my way is not perfect. Other people might have different ways, but this works for me. I just got my Sure Dividend retirement. Remember I told you guys back in, I forget what episode it was, that I have a couple that I pay for. Well, I pay for the Sure Dividend retirement premium service, and I just got my email today about my Sure Dividend, and my valuations are pretty much spot on with their valuations, so that's good. So we're going to walk you through how you can come up with a plan of attack for when you have cash or when you want to dip your feet in the market more. It'll teach you guys what I look for and what I think would be beneficial things for you to look for. If you don't duplicate what I do, that's fine. But like, these are some things that you should look for.
And since we just talked about how the market has its, how did you say it? You said that most of that down is in.
Most of the down is in. So
now's a good time to start looking for building your watch list.
It could still go down, but it is a good time to actually develop a watch list so you can say, oh, I want to get that one at that price.
Yes. So that's the whole point of this. We're gonna
show you some value.
Show you where to put that seed capital.
Have some good dividend yield. So that's my list. The first one we're gonna go over CIVI, CIVI, which we actually hold in both the retirement and the van life portfolio.
All right, so we're gonna go into the Schwab's.
Okay, so we typed up here in the search bar up top. We typed in CIVI, and then that'll bring up this here. CIVI, so you see it's currently at 27.31 because you want the at close price. The after hours doesn't really, that's the way it's going to fluctuate. So the very first thing that I look for whenever I'm evaluating something is scroll down. While I'm scrolling down, I'll see the dividend yield is 14.72. See it right there. You'll see that it's paid 50 cents the last 3 quarters, and then there was a special dividend in third quarter for 102. So
look at that.
So that's the base dividend's 50 cents. With the special dividends and the 50-cent dividends for the last 12 months, you're going to see that it comes out to 401 right above it. So the annual dividend yield is based on that 401, which might not be accurate. Because of the special. Yeah, because of the special. You can, if you really care, you can figure out your own dividend rate. You literally just take the regular dividend, which is 50 cents, take it times 4 because it's quarterly. So you'd have $2, and then you divide it into the share price and give you your annual yield.
Ah, okay.
But I don't care about that. I just take the annual dividend yield. That's what I go with.
Yeah, because this changes all the time.
So that, while I'm scrolling down, I'll see that the dividend yield's that. But when we get down here to earnings, this is the first important thing that you see that they are projected. This is what all the experts say. The quarter 1, 25, 2, 25, 3, 25, and 4, 25. That's what the experts are projecting that this particular stock, CIVI, will make in the upcoming year. So that's quarter 1's estimate.
$1.63.
The quarter 2 is right beside it.
$1.58.
Quarter 3 and quarter 4. So that covers the dividend of 50 cents. That's the first thing you want to look at. But that's not for a valuation thing. That's just anything you're looking at. You want to make sure that their projected earnings
cover their dividend.
And then you scroll down a little bit more. Then you'll see here's their last 4 earnings.
So under the historical earnings tab.
The blue one is their actual.
That one.
So they actually cover their dividends the last year as well with 274, 206, 199, and 178, which is cool. But then we're going to get into the stuff that I actually look at. Okay, I look at the earnings per share, EPS. So that means for every share they're generating that much cash. Then I look at the price to earnings, which is the current. Oh, I'm sorry. That's the last 12 months price to earnings, and then the forward PE right below it. That's the next 12 months price to earning.
So the current EPS is 8.46, the price to earnings is 3.23, and the forward PE is 3.87.
So those are the three numbers that I'll look at, and then click show more. So the earnings per share actually decreased from 2023 to 2024. So you see it right there, and it decreased from 2022 to 2023 as well. That's the gap. That's when they take in all their accounting
fun
things.
Stuff.
They finagle with their accountings. The non-GAAP is without the accounting practices. I look at the GAAP because that's like I almost say the most popular one, but that's the one that everyone that bases their research off of.
Oh, okay. So it's the one that's across the board standard.
Mm-hmm. So then you'll I'll scroll down and see what it says below that. There you see their but then you'll see their revenue actually increased by 50%. So that's cool. And their cash flow increased. I don't use these for valuations, but because the EPS actually went down, I want to make sure this is like making sure that they actually are generating revenue and their cash flow is actually positive. Because it's positive, that's cool. And when I get to the chart, when I get to the chart, When I get to the chart, I'll show you all this inputted in the chart. And then we scroll down here. We want to look at this is for the dividend purposes.
So are we looking at the peer ratios?
Click the valuation tab.
So under peers and ratio comparison, you click on the valuation tab in Schwab.
And then the next one I look at is the price to tangible book. This one right down here. Price to P, that's the P to B. They have the price to sales, but I just like the price to book as a better valuation metric. Okay, and then we go into Yahoo Finance because I found this is the best. Like Schwab should be free. I mean, I think you have to sign up with like Social Security and whatever.
Hey, I can't remember if Schwab actually has a minimum balance requirement or not. I think that's gone away pretty much since everything got so competitive. But
and then the Yahoo Finance is free. Then you click on the search bar up top here.
And you type in Civi.
I
can't believe Trump looks like that now.
And you click on the analysis tab.
Okay, so on the left-hand side, analysis tab.
And you see what all the experts, you see right here in this middle column, analyst recommendations. You'll see the total number of analysts covering this is 16, the top number.
Okay.
And you'll see what their price target is, to 52.33 over here. That's important to know.
What are we scrolling down to?
To growth estimates.
Okay.
And then you'll see that they're projecting for the next 12 months 6.85% growth.
And the S&P is projected to be 14.14.
So, with all those numbers in mind, I'll show you why I look all those numbers up here in a second. So we'll highlight the Civi column. Civi. So you plug in the forward PE, which when we were in Schwab, we noticed that was 3.87.
So we created a spreadsheet, and you basically just plug and play.
And then the current PE is 3.23. The current industry average is 12.11. If you don't know where to find that, go back into Schwab once. Scroll all the way to the top. This is why I really like Schwab. Click on this oil and gas consumable right there.
So it'll give you your, what is that, sector?
Yeah, that's the sector that Civi's located in. And then you click on the valuation, and it'll tell you what the oil and all the sub-industry here, what the average price to earnings is for all of that.
So that's where he's getting that number, 12.11.
And then you see like right next to it's the price to sales. If you like the P to S, you can use it because it's right next to it. You'll see that this is well undervalued compared to its peers. But go back to the spreadsheet. Okay, so the industry average is 12.11. So you can see by that its current PE and its forward PE, it's well under the industry average. That's why they're both green. That means that's the go zone.
Goes down.
Okay, then the next column you have is the earnings per share, which we got from Schwab, remember? And then you have the previous earnings per share right next to it. It was 902. And then so you actually have to put in a mathematical formula. You take
your EPS
divided by your previous EPS, and then you subtract 1 to get its percentage.
Okay.
So you see it has a negative 6.21 EPS growth the last year, which isn't that detrimental. That's just for me to know that, okay, I need to watch this one more. Okay. Then the price to book was in your Schwab page.
0.38.
Then to determine the PEG. Now, there's different ways to determine the PEG. What I use C4.
The current PE.
Which is the current price to earnings divided by H4, which is the projected growth we found in Yahoo Finance. And that gives us a PEG of 0.47. Okay, for the PEG, a simple 1 means it's fair valued. Anything below 1 is technically undervalued, and anything above 1 is technically overvalued. But then that does differ from sector to sector. That's why you'll see some grays down here. Like 1.14, that's a gray. That means I have to pay attention to it. And 1.37, you'll see some that are actually above 1 that I have green still, but that's because the sector is higher, has a higher peg to begin with. Like technology pegs are like 4 to 5. Price to book right next to it is the same exact thing. Like 1 is technically what the experts think is fair valued. Under 1 is undervalued, and over 1 is overvalued. So like if you can see what we're doing here is we're creating a puzzle, and we're putting all these data points in here to determine if this is a good value investment at the current price. The next column we got from Yahoo Finance as well was the average price of the 16 people covering it. Now that does differ from stock to stock. Some will have 4, 5, 6 covering it, and others will have like 30 or 40 depending on the popularity of it.
Yeah.
So you see the current price of $27.90, and then you'll see what the experts are projecting this to be worth within 12-month time is 52. So this is going to double in price. So that's 100% gain.
So the current price, and then if you compare that to the average target price, so it's almost
100% gain in the next 12 months. So then you add it all together. You see that it's undervalued with the PEs. You'll see that it has, you have to watch the EPS growth, but you'll see that the growth rate is pretty decent at 6.85%. This column here is percent, but because Google Sheets is stupid as shit, I can't really have a percentage there of 6.85% and then divide it with the PE because then it does some wonky shit. So you actually have to leave that. But this H column is the percent of growth. So you'll see that it's projected to grow by about 7%. So that's good. You'll see that the PEG is below 1, which is the price to earnings divided by the growth, and you'll see the price to book is below 1. So that all these factors indicate that this is super undervalued. So that's why if you see the very far right, I have strong buy because it is like. So
you're looking at the growth rate. So what you would have done if this was the gray column, I assume gone back into the.
I'll check into it.
You'll look back
every quarter to make because they report their earnings every quarter. Then I'll. But
this will go on the watch list and high up.
Well,
on
we're
it.
Actually in it.
Oh,
we're in
okay.
both.
I know we're in Civi, but I'm saying like from now price point. If you're not in it,
it's still a strong buy based on the EPS growth because they do they'll do some accounting practices where like sometimes the earnings per growth will be negative, but it doesn't really matter because it has. If you look at the full picture of like a 5 to 10 year horizon, the 1 year of negative earnings per share is not that big a deal. Like they'll write stuff off. Like if they make a purchase, they'll write that off, and that'll actually cause their earnings per share to go down.
Okay,
Things
so
of that nature.
The column on the very end of the right here, we'll make this sheet accessible in the show notes. But the strong buy means you could buy it now. You don't have to wait for the further drop to come in.
Right.
Okay.
I would buy it I am still buying into it. Every time I have cash laying around, I'll pick up a couple shares here and there.
Okay. So Civi's a strong buy right now.
So we have 3 layers of valuation in here. We have the price to earnings, and we have the PEG, and we have the price to book, and then we also have an idea of where it'll be with the average target price versus the current price. So we have 3 layers of valuation metrics when we're trying to find value growth stocks. So like that's pretty good. That's the reason that's a strong buy is even with the negative earnings, if it keeps up a 10 to 14% yield, that's pretty sick. And then you have 100% potential from the current price to the average target price by the experts. So this one's a complete strong buy. Yeah.
And Tim has the ones in the left column bolded that are the strong buys from what I'm seeing.
Yes.
Yes.
So the next one on the list is MPLX. It's an MP that deals with oil. Civi's a straight up oil play.
Limited partnership?
Yeah, LP.
Not MP, LP.
Civi's, I think, the midstream, whereas Mplex kind of encompasses all of them. They have the upstream, the midstream, and the downstream. If you're not familiar, the upstream is where they do the exploration. I can almost say that word. Exploration for oil.
Should be used to his mispronunciations at this point.
The midstream is where they actually transport the oil, and the downstream is where they actually will refine it and make it ready to ship to wherever they're shipping it to.
Okay, so Civi and Mplex are both oil plays.
Yeah.
Okay.
Mplex is just a weight. The reason it's a weight is because its price to book is 9.1 and its peg is 2.27. You see like the two warning signs in this call, like the red ones I made for a red flags. Like, okay, let me double check this.
So red is bad.
The gray ones are check back in and watch them. So this was a weight, even though a lot of the experts really, really like this one. Like you're not making enough. You're only making like $8.
Yeah, if you look at the current price of 48,
which would be 4% plus an 8% yield, but because it's so overvalued, like it has the potential to be super overvalued with the price to book. Like the earnings per share looks pretty good, and the EPS growth looks phenomenal. 10%. It's growing at 10% per year, but that price to book, like it's not all encompassing. You could buy this if you wanted to, because you have a potential for, if everything went according to plan, the next 12 months, it would be about a 11% gain. But
yep.
I would wait because I think it'll actually come down in price, and that's my 2 cents on that one. Next three are closed-ended funds. Closed-ended funds are evaluated differently. I'll show you. I'll remind you how to do that in Schwab here in a second. You can't use the same metrics when you're evaluating closed-ended funds. It's literally just, if you're not familiar, closed-ended funds where they hold a bunch of things in a basket. Like they'll have a bunch of different stocks. Sometimes it's sector-based, like they'll only hold like oil stocks, or they'll only hold like tech stocks, or only hold like AI stocks.
We previously did a closed-ended fund evaluation of how we actually go through, and I think we did several examples of it. I think it was episode 59. If you go back through the podcast, where we actually have a YouTube video that goes through the walkthrough of it. So if you want to know how to evaluate those with the NAV and the history NAV, so you can see if it's actually overvalued or if it's consistently overvalued to what its previous NAV is, because that's what differs with these closed-ended funds.
But we'll look at, we'll type in BizD into Schwab.
BizD, I will. BizD.
BizD.
I was looking at that ticker because it's hilarious. BIZD. Oh my God, that's so funny.
Oh, that's actually ETF. ETF, like I'm sorry, ETFs and closed-ended funds are kind of similar. So go into...
You kind of consider them interchangeable?
I do. Go into ASG.
Liberty Star. That is not what I expected a name to be.
So this is a closed-ended fund. To evaluate closed-ended funds, you want to scroll all the way to the bottom in Schwab. I don't know if other brokerages have this.
There's like a map.
Right here, but like here, they have a price...
Premium to discount.
Premium to discount. And you'll see that it's currently at negative 6.24%. So that means all the stocks they hold in the closed-ended funds, if you tabulate it all up and you divide by the total number of shares, the closed-ended fund should be at 513 and it's at 496 or whatever. So it actually has a 6.24 at this moment in time discount to its NAV price. If you look up here in the 1-year chart, you'll see that it says negative 7.79 right there.
Yeah, it's hard to see because the chart's stupid. 7.79.
So that's the 1-year price. So it's overvalued compared to its 1-year price because negative 779 is below negative 6.24. But I don't really use that. I use the since inception tab.
Oh, so you can change. Yeah, you want as long as you can get for the most accuracy.
And you'll see that if you do the reason why I do since inception is it gives you a wider swath of data. You'll see that it trades between a 13% premium to a 24% discount, but its average is 5.94. Is that what that says?
Negative 5.94.
Negative 9.9. So it's actually undervalued because negative 5.94 is actually less than 6.24.
Math counts.
So it's slightly undervalued.
Slightly. By like 1%. 0.5%.
But that's that really, really simplistic and quick way to evaluate closed-ended funds.
And if you want more details, go back and watch episode
Now with
59.
ETFs, click back on BizD because it's
BizD.
It's right next to it. Yeah, ETFs, they have something similar, but if you're not familiar with ETFs, scroll all the way to the bottom.
Bottom of it again. Yeah, I knew it.
If you scroll all the way to the bottom, you'll see that it's at a negative 3.4 and its 1-year average is 0.07, and that's just a 1-year time frame. And if you click on the since inception,
0.08 is the average.
And the reason why this ETF's undervalued because what they do at the close of business with ETFs is they try to make this premium and discount close to zero. Like at the end of every closing day, they'll take all their holdings and they'll divide it by their share price, and
So that makes these harder to evaluate?
Not really, because what you do with these, like this one's undervalued because it should be around zero. And it's at negative 0.34, so it's slightly undervalued just based on that. But then what you do is you clear that off and then scroll up to its holdings. You see over here in its holdings.
ARCC, one of our faves.
Because I know...
Damn, look at all that red. The market got trounced.
Because I know that what it holds, most of these are undervalued.
HTGC, Maine, FSK. We have all of those.
Yeah. But that's just because I know the stocks. Now, you can go into each individual stock and see if they're... Because, like, if you see that 20% of its holdings are in ARCC, I know ARCC is undervalued. 16% is in treasury bills, and I know those are... They can fluctuate, so it is what it is. I think they're overvalued right now, but whatever. You'll see that 12% is in OBDC. I know that's undervalued because I look these stocks up every week when I do the top 10 chart.
And so I know, a lot of them are in our portfolio.
I know the BDCs are all undervalued. And most of these are BDCs, except for that the BXSL I'm not too familiar with. I think it's a financial stock.
Okay.
The finance is undervalued as well, but like that GBDC is a BDC, HTGC is a BDC, Main Street is a BDC, Fisker's a BDC. So I know most of these are undervalued. So I know to evaluate an ETF, what you're basically doing is you're looking at the holdings. If the holdings are undervalued, then the ETF as a whole is undervalued. If the holdings are overvalued, then the ETF as a whole is overvalued. So with YRLG, it is a covered call ETF.
So we don't have any data because these are funds. Because
it's an ETF, that number where it says discount to NAV, that should be closer to zero. Because it's the fact that it's negative 1.47 and it's not closer to zero, it's undervalued. And because it yields 26%, I do believe the bulk of the downturn of the market is behind us. It may go down some more, but it's not going to be like the 15 or 20% that it's gone down. If you don't know, RYLG is small cap, and the small cap is part of the Russell. The Russell's in a bear market. It's down like 22%. It could go down to like 30%, so you're going to lose like 8%, maybe 10%. But because the yield is actually going to be more than the drop down that I'm foreseeing in the small cap,
you have it as a buy.
It's a buy. BizD, another ETF. Because I know the BDCs are all undervalued in that one, I know that 11% yield is going to more than make up if it goes down some more, because it could go down, but they're all undervalued. Most of its holdings are undervalued, so this one should go up. So it's a buy. ASG is a hold, even though it actually is undervalued. Wait. Don't buy it yet, because I do think based on what it's holding, I think that ASG could go down a little bit more. And it's a hold because if you look here, you'll see that its current price is $481 and its average target price is $495. To find that out, you actually have to go to people that specialize in closed-ended fund, whether that's the Contrarian Outlook or you Closed-Ended Fund Connect. So it's cefconnect.com to find what they're projecting. What I do when I do this is I basically take the difference between the discount to NAV historical and the discount to NAV, and in this one it's 0.3%. So then I take the current price times 0.3%, and then I add that to the current price to get its average price. So this one's not going to go up very much. So then you have to determine, is the 9.5% yield enough for like minimal, maybe 2% gain? It's not. That's why it's a wait. Okay. I think it'll go down, and it's not really going to go up too much.
All right.
Next one is LPG.
This is a regular stock, right?
Yeah. LPG is perfect across the board. You see that?
Yeah, it's all green. Forward PE looks good. Current PE looks amazing balls. It's definitely undervalued based on the industry average PE by a lot. EPS, previous, yeah, lots of green.
Yeah, and this one's projected to probably go up by about 40%. Based on what's current price versus all the experts, what they think.
13.5%
yield.
Strong buy.
The only problem with LPG is it doesn't have like a consistent dividend. It's like when they have money left over, they give you a dividend. And if they don't, if they have free cash left over at the end of the quarter, they'll give you a dividend. So some quarters you won't get a dividend. Some quarters you'll get like a $5 dividend.
So if you want stocks that are a consistent dividend and predictable for like a monthly, this one may be one to put down on your list. For the rest of you who don't care, do we have LPG? I was gonna say we get into variables because sometimes they drop nice ones. All right.
AIPI is one that we hold in both accounts again, and
this is a fun rec share.
It's an ETF. It's a rec share ETF. So the discount to NAV and the discount to NAV historical is going to be pretty close to zero. This is a strong buy because I know exactly what AIPI holds. It holds all the AI stocks, and they've all been trounced because their tech stocks are down 30, 40, 50%, some of them.
Yeah. And
they write covered calls on all the shares they hold. And because most of the downs behind us, I think the 40% yield, even if they shrink the dividend, that yield's still going to be in the 20s.
Well, the yield's like almost 40%. And I was going to also say, just because of the macroeconomic climate with or I guess macro trends with the AI sector, like this one, strong buy.
I have no qualms recommending AIPI.
40% yield, baby.
Next one is one that a lot of people really like. And when I dug into the research, it's eh.
Oh, really?
I have it as
You bought UPS.
Yeah, I have UPS in both portfolios.
Interesting.
Because it does make a lot of money, and it should be trading probably about like $30 more than it is.
So this is one of the dividend growers, I assume?
Yeah.
Because you hear about it all the time. So yield at 6.76%, that's actually really high for a dividend grower.
UPS generally has like a 5% dividend, so you're actually like getting like 2% extra.
So that means it came down a good bit.
That's why we bought it. That's why I got into it.
But talk about the red flags. I see you have the EPS,
EPS growth
column.
is down a lot. This one, if you're not familiar with UPS,
I don't know how you're not if you buy anything.
Will come out from under your rock. UPS delivers packages, and because of tariffs and because just competition, UPS is actually, its revenue and its earnings per share has just kind of decreased like the last 3 to 5 years. The last year it was down 13%. Its price to book is really high at 8.8, and its PEG's even pretty high at 1.14. The only reason I got into it is because I know that it's about $30 undervalued, and I'm getting a pretty high yield of almost 7%. While I wait for the price to get back to where it should be. This one will probably be one of the first ones I sell once it gets back up into the 130
just because
range.
of the actual metrics. But so Tim will swoop in a lot of times and get these quick buy for the turnovers, because this thing's average target price is 127-ish, and it's currently at like 97. So that's a quick turnaround if that does come to fruition. Why the hell do you have FEPI away from AIPI? They're the same.
Just happened that
Rec
way.
shares. Your sorting is terrible.
FEPI is the exact same thing as AIPI, except FEPI holds like tech stocks, not AI stocks. It yields 30%. Again, I know everything that it holds is undervalued, so the price should appreciate a little bit. You have to remember with covered calls, say all the stocks in FEPI or AIPI, they all went up 20% because they're doing covered calls. You'll generally get half of that. So if it goes up 20%. You're only going to get 10% price appreciation, but you're still getting the 30% dividend. This one's just the
ones with the high dividends are basically more for the dividend, not for the actual.
Both AIPI and FEPI are my income producers. I just get money from them and I dump it into other stuff. So like when I get my cash payment in April from AIPI, I'll probably dump it into Civi or LPG because they're both strong
undervalued.
buys.
Strong buy. Yep. So this chart will be really nice.
The next one is another one that a lot of people really think they should get into, and the metrics are really good. Like the only one that's as a red flag is the price to book, but what
is ET?
ET is the oil stocks, energy transfer.
Oh, okay.
It grows its dividend. It has a really good
7.96% dividend currently.
Nice high yield, and it has a lot of price appreciation because you go 16.33 to 23. That's like 7. That's almost 50% gain.
Nice.
And it does grow its dividend. The only problem, the qualm I have with ET, why I don't own it, is because I can get into SRV, which has ET, and it yields more. SRV, if you're not familiar, is a closed-ended fund that literally just holds all oil stocks, but it's not on the list because it's not undervalued.
So this is a way to get into potentially that. You do have it set up as a buy here. It's not a strong buy, but it's a buy because of the...
It is a buy, yeah.
Price book?
Yeah.
Is a red flag.
Next one is a mortgage REIT.
AGNC. We've talked about that a bunch.
Mortgage REIT differs from a general REIT. A general REIT, remember when we went over REITs, is general REIT holds properties and makes rent and stuff like that from the properties.
Is that a typo?
No.
That's not a typo? Whoa.
And mortgage REITs, they hold mortgages. Like they hold paper. They don't hold buildings.
So what I just asked about, the EPS growth for a lot of these is 54, 13, 17, 123. AGNC's is 1,760.
But you have to remember with
that?
EPS, there's a lot of finagling with the accounting. That's why it's just a way to, you're basically verifying that it's growing. and it's making money. And one of the ways to do that is the earnings per growth, because that's...
Yeah, I'd be skeptical of that number just because it's so out there.
It's gray area. If you see there, it actually has a negative projected growth. So that, again, you're in the risk-reward scenario. You can see that it's undervalued based on its PE and its price to book, but it's projected to actually lose money.
Yeah. But it does pay 17%
so at that point,
dividend.
At that point, you're going to, is the 17% yield worth the 2% loss in growth?
And that would be a yes.
To me, it is.
Yep. So it's in the buy category.
So that's even like worst case scenario. Like absolute worst case scenario, that's like a 15% yield. Next one we actually hold is SCM. We have it in our Schwab account. Everything looks good, again, except for the projected growth. I think of this has a lot to do with interest rates. That's why the BDCs have like projected growth of negative numbers. Once interest rates come down, they'll be able to refinance their debt while holding, while their loans they have outstanding are at a higher debt. So their earnings per share and their revenue, all that will grow a lot. SCM is a wait because the average consensus price target is not very much higher than the current price.
Yeah, so $12.24 versus $13.75. That's not much of a price difference. So yeah, I would imagine waiting would probably be the right answer because we do probably still have some down to go.
Well, because it's interest rate sensitive, It doesn't.
Mm-hmm. But still.
Next one is one I actually got asked specifically by her uncle. Ford.
Is that actually Ford?
Ford has a lot. All the numbers are really good in Ford until you get over to the average price projected. It's only they're looking at, what is that? Like not even 10%.
Not even. So it's $9.33 right now, and it's projected target.
But I think it'll go lower because there's a lot of shit going on with like automotive,
the Canadian freaking tariffs,
like and because
EU.
If you look at its yield is really pretty high for Ford.
6.43.
It's generally like in the 5 range. So like
I'm assuming that's another dividend grower.
Yeah, they grow their dividend, but I'm holding off on that one until I see what happens with the auto tariffs and everything.
Yeah. And there's better ones to buy.
If the auto tariffs get paused like all the other tariffs, I'm pretty sure the average projected price will increase, and then this will go from a wait to a buy or a strong buy. ARCC we were just talking about is awesome.
It is awesome.
It is the by market cap largest BDC.
We got some flags here. EPS growth of negative 8.96 and projected growth of negative 1.42.
But the reason why it's gray instead of a red flag is because the majority of the BDCs have the negative EPS
Same problem.
growth. So it's
Same problem right now.
It's comparable to its sector.
It's an economic climate problem.
And its projected growth is negative 1.42. So then you're looking at is the
9.64%.
10% yield plus the price appreciation of about 25%. Is that worth the potential negative growth? And to me it is, because it's like a 10 or 11%.
So that's on the buy list.
Next one is one that gets a lot of shit, and I didn't know why until I looked into it. Apparently Target's woke.
Woke?
Yeah.
That's why it's getting a lot of shit?
Yeah.
Oh boy.
But it has pretty good numbers, other than the PEG is a little bit high. I'd like to see that a little bit lower. But then its price to book is a little bit high as well. But
a little bit. That's a red flag one on your list.
Yeah, because
3.01
in that sector, that's like pretty high.
Okay.
That is like it's like a consumer defensive. Okay. It's like Walmart in some ways, and Walmart and Target, they get lumped together.
I don't like the low dividend of 4.8%.
But to me, it's a buy because you see that it's projected to go up by like 30-some%. While you're waiting for it to go up 30%, you're collecting 5%.
Would you actually buy this one though? Because it's still close to the $100 mark.
I wouldn't. It's too much for me.
Yeah, because we don't really like those higher price quantities, especially with that low.
But for everyone else that wants this,
but if you want
security blanket,
it's definitely in a buy zone then.
Yes.
Ooh. IIPR.
IIPR is
the weed.
It's technically a weed REIT, but they perform more like a BDC because they're lending out money and buildings that collect rent. The reason it's a weed REIT is because they collect rent from the people that rent their buildings, but they actually do lend out money as well. So it kind of like has a BDC/REIT kind of hybrid thing going on. It's ridiculously undervalued, even with all these gray numbers.
Yeah, there's a lot of them on here. So you got your EPS growth of negative 4.33, Projected growth, negative 0.32.
This one they buy because you go all the way over to the right. You'll see that it's going to go up by like 21. So that's like a 50% gain. Plus you're getting the 15% yield.
Yeah, that's totally worth it. Like I'd have that in the buy category
But
too.
like all this, like when it comes to valuation, like what you guys have to remember is that like you're doing a risk reward scenario equation, whatever you want to call it, in your head of is the price appreciation plus the yield worth any of potential red flags? And then you have to make that decision for yourself.
Yeah, and that's definitely completely subjective to the investor.
And the next one, if you own it like I do, you have to...
But I still can't believe IIPR is down that much. We were talking about it in the hundreds. Like,
yeah, it should be about. It should be in the 90s.
It's crazy. Sorry,
So
I cut you off. Skyworks.
This one's IIPR is gonna double, but it's how long it takes to double is the question. Skyworks, we own that in the retirement account. The reason we own it is because its dividend is normally like 1%, and it has a 5% dividend.
Holy crap, that's a heck of a jump. That thing obviously fell off a cliff.
Yeah, it was in the 112 to 125 range.
It's right around 56 right now.
Yeah, but it has a shit ton of red flags. So it's in the retirement account because I don't expect to actually make any money off it for like a long time. If you're not familiar, Skyworks makes like chips.
Yep. And that was the one that Apple said.
It made chips for Apple, and Apple said we're going to give you 20. We're actually going to reduce your revenue by 25% because we're only going to be collecting 75% of the chips that we normally do.
So I'm guessing that's why the EPS projected.
EPS went down because that happened, and the projected is down, and the price to book is too high. So there's a lot of red flags in this one.
Yeah. So again, the EPS growth, negative 40%.
This was just a buy and hold. Like I only put like 1,500 to 2,000 into it.
But we bought that before the market started imploding too. So
yeah. Now
it's just turn the drip on and let it do whatever it's going to do.
Next one is like a lot of the income investors really like STWD. It's a REIT. It holds like a single. It has like single family home residence. It has some multi residence. It has some hotels and things of that nature. Its price to earnings is kind of high right now.
Yeah, so that's a red flag for this one.
To me that means
above the industry average.
Just wait right away because like the potential is for it to drop.
Yeah.
Just to like when you're above the average, that's an average for a reason. That means all the REITs tabulated up come to that industry average price to earnings, and if you're above that, that means you're higher. You're up on the bell curve that needs to come down, so it's going to retreat.
So Tim automatically stuck this on the wait list, even though it has a 10% yield. There's two other gray flags, so.
The EPS growth, like the growth should be higher because they actually have higher interest rates right now. So that's why that one's even though it's positive, it's still something to watch for because it should be higher, and its PEG price to earnings divided by its growth should be a little bit lower, but it is what it is. That one, some people like it, some people don't. For me, I don't. Right now, I think once it drops probably to the $15 range, then I would probably pick it up.
And it's like at $17.82 right now, so. Watch list it.
But there's other REITs out there that are better. RITM, Rhythm Capital, is a BDC. It has pretty good numbers across the board. The only
projected growth
stuff to look at would be the PEG and the projected growth. Again, as a BDC, it should. But this is one of the BDCs that actually has a projected growth that's like higher than 0. So that's good. So I like this one to buy just based on all the data. But it's one that you have to check back in.
That's really good price decline. So it's like 10% yield. It's currently at 9.76, and the average price target is 13.27. That's a pretty good jump.
Yeah.
So yeah, I could see why this is on the buy list.
And the next one is one we got rid of.
Pfizer. Any regrets?
No.
None.
It's technically undervalued, but I think it's overvalued.
Interesting.
But it has buy based on the numbers because its yield should be like 5.5%, and it's at 7%, so it has a little bit of room to grow.
And Pfizer's one of the dividend growers.
I just don't like that Pfizer. That may change in the future, but this is the one. If you remember when I said I sold this one, it's because it didn't have as money invested in AI like the other pharmaceutical companies did.
Yep, and again, it was kind of like if the old stores, the brick and mortars, were not going for like the online shopping, like look what happened to them. They went to the wayside.
But it does have good numbers. Like its PEs are good. Its EPS growth is good from 23 to 24. It has decent projected EPS earnings growth of 3%, but it has a high that's a relatively high price to book of 1.41. But you'll notice in the pharmaceutical area that the price to books are generally like 1.5. So
Okay,
like
so that's not out of the
norm. That's why it's green.
But the peg's high.
The peg's high, but I just don't like Pfizer. But I have it as buy because all the numbers say it's a buy.
Yep. And if you're into that, then we gave you guys the green light.
Rio is a metals and mining one. It has really good numbers except for the peg. It has a lot of room to grow. What is that? $23. So that's like that's damn near 50% plus a 7% yield while you're waiting on it to get up there. So you're looking at like
that looks nice.
Probably 50% gain in price if you just hold it and wait for it to come around. I was hoping to get into this one, but that peg number is a little bit high for me. Like it should be once it drops down to like 2, I may consider getting into it. I think it's going to go down a little bit more before it goes up because the precious metal sector is not. I think it's like overvalued as a whole. Gold's up to like 3,300. Silver's at like 32.
So that one might show up in our portfolio.
Yeah, that one might be in the portfolio at some point.
Coming soon.
ITRN, new one to me.
I've never even heard of that one.
Never even heard of it, but it's fucking stellar.
How'd you find that one?
It was in like
again one of these list pools.
It was in the email I got, and I was like, "Hold on, let me check it out."
See, this is why Tim's on those lists. Like, we find stuff all the time.
But the numbers in this one are impeccable.
Except the price, what is that? Price the book's a little high, but nothing crazy because, like, it's 6% yield.
I have no idea what they even do. But the numbers are awesome. So if you're looking at like a $30 stock that yields 7%, that you can make, I don't know, what is that?
It'll go up 15%.
15-20%. So you're getting a 30% gain within like 12 months. That's a good one to look at.
That's crazy. Strong buy.
All its numbers are sick. CPA is another one I never heard of, but I got an email. And it has...
green across the board on this one.
Green across the board. And it has a lot of room to run.
$87 currently. Their average price targeting at $150-ish. $149.
So $60. So that's like 70%.
7%. Yeah, strong buy. I concur with the strong buy.
AB we actually have in the portfolio.
Yeah, I recognize that.
It's a wait because the average the consensus price is below where it's currently at.
Oh,
but all of its valuation metrics are sick.
So hopefully
because they're expecting the average price to be below where it's at, that's automatically a wait.
Red flag.
That would be like it would be a sell, but I would never sell it because
you putting the drip on this one?
Yeah, it's a dividend grower, so I'm just gonna keep the dividends coming in.
Okay, I was curious to see if you'd turn that off. Next one is
Wes is a midstream. Remember we were talking about the midstreams. This one's a really this is one that a lot of people like, but to me it's a wait because that price to book is super high compared to its
5.41, and it doesn't have that much dollar increase to go. I mean, it's still about a 9.5%.
Yeah, you're looking at a 9% return if it doesn't drop to.
But that one actually went on the wait list because Tim actually said that price to book is so bad. So okay.
The next one's one that we're in.
Yeah.
TRMD. Really like it. It's a strong buy as well. TRMD, like its numbers are really good except for its EPS growth. But again, EPS is not like a valuation metrics. That's just a financial metrics that you look at to see how they're doing. This one here, they had some write-offs and things of that nature, so the EPS actually dropped. But you look at everything else, like it's projected almost 10% growth. Plus, its price is about its share price is
plus the yield's 32%,
66%. Plus, you have a 32% yield. So this one,
strong buy. I get that.
Super strong buy. It's in the oil field. It's in the oil industry, so it's volatile with the prices. It's not going to go straight up, but I think with that yield plus the potential for the price appreciation, that's a no-brainer to me.
Yeah, that's worth it.
The next one we actually held up until middle of 2024. We got out of it because I thought it was overvalued, and it BDC, but you see that it has a
CSWC
negative, almost has a 5% projected growth loss. When we got out of it, it was at like 2370, I think, around there, 2370, 2350. So we got out like right before it got up to its average price.
Currently at 19, so good call.
Because it's a BDC, that projected growth number is going to be. It is what it is until the interest rates get solved. So it actually is a buy because you're making 13% plus 25%. So you're going to like 30-some%.
Nice.
ABR we actually hold in both portfolios. It's pretty sick. It's a dividend grower. So like that's why it's in the retirement account. And you're getting like that. Its normal yield is around like 11 or 12%. So you can see it's undervalued a lot just based on that.
Yeah.
The price, it's only
But we knew this one dropped a lot.
I'm only expecting it to go up like 20%, so you're looking at like 36% gain. But the EPS is a concern with this one, and this one actually is a legitimate concern because they have some debt coming due in 2025 that they're hoping the interest rates drop so they can refinance it at a lower rate. If they can't, they're going to have to refinance it at the rate it is currently, and it's going to actually cut into their revenue and stuff. So this one is actually...
you said that this one had a potential dividend cut coming.
Yeah.
From what I remember.
I can see a dividend cut coming. Yeah. This one, that 16% is way too high.
And you still have it in the buy category.
Yeah.
I was like, yep. I have my drip on.
I do. Fisker we hold. Again, another BDC that we hold. EPS growth is the projected growth is but if you look at the numbers, it's projected to go up. What is that? 12%, plus you're getting 15%. But it's a wait because I really like this is another one. I think they're too much in debt because their EPS growth is actually down the last 2 years.
Okay.
So I have to see what they're going to do with their debt that they have coming due in 2025 before I can actually move this to a buy as opposed to a wait. So
this one was a deeper data actually signaled a wait.
Yeah.
Okay.
Next one is one we hold in the retirement account, and it's pretty sick.
SBLK.
It's a.
I know we talked about this. Green Across.
Green Across. They transport stuff across the ocean.
And 15% current yield. I don't know what the heck that. $14 price, $22 average target.
Like $8.
Yeah, that's pretty good.
That's more than 50%. Plus, you're getting 15%, so that's like 65 if everything goes according to plan. So.
Strong buy.
Yeah.
I don't recognize the next one.
KYN is a closed-ended fund that deals specifically in the energy sector, and it is ridiculously undervalued compared to where it's been.
15%.
Yeah. So
Jesus.
So that's a strong buy. That's a really good one.
8% yield. Yeah, that's pretty nice.
ETV is a closed-ended fund that deals with state government bonds and things of that nature. It doesn't look like a lot. It's only like 3%, but because it's dealing in state and local bonds, it doesn't really move a lot. It takes forever so it could probably take 2 or 3 years for that to go from to close that discount to where it should be. So you're collecting almost 10% for like 2 to 3 years. So I was
gonna say, where the hell did the 3% thing come from? The price appreciation. Yeah, okay. But the yield, yeah, that's a big yield. So that's
once you get more familiar with things, you'll understand how they work. The Eaton Vance closed-ended funds, for the most part, they deal with bonds that deal with governments and things of that, and treasuries and stuff like that. So they move really slow as opposed to other bond funds that deal with like corporate bonds. They actually can move faster, but like government bonds move so slow that like that 3%, I could see this taking at least 3 years before that.
I could see government bonds going really slow too. I used to work there, and there were a couple, man.
So that's why that one's a buy, even though you're not really getting a lot of like price appreciation. You're getting a lot of dividends while you're waiting. This is one that I've been.
And bonds are starting to come back in favor, aren't they?
Corporate bonds,
okay.
Government bonds have never really went away.
All right.
This is another one I get asked a lot about SLRC because I guess people like the yield of it.
11.2%.
It has good looking data. The projected growth for this BDC is way lower than like most of the other BDCs, so I could see this one, I can actually see this one making you about 20 to 30%.
But the little bit of discount price it's at, plus that 11.2%, lands it in the buy category.
Yeah. Next one's a strong buy. It's one that we actually have in her retirement.
Is Opera actually a dividend payer? I thought that was one of our flyer stocks.
It actually does pay a dividend. And
Interesting.
The dividend is normally under 1%. So
holy crap. And it's at 5.35? Yeah, that's a big... This thing must have fell off a cliff.
This is a internet tech stock thing. But it's the internet in, I forget which foreign country. I want to say Norway, but it might be wrong.
It's probably one of those Scandinavians, because back the torrenting, it's usually like one of those.
But you see that its EPS growth from 23 to 2024 was a really, really abysmal. But you see its projected growth is ridiculous.
Yeah, so like the previous growth, negative 46%.
So to me, because
projected 23%.
And I remember I said like the pegs in tech stocks are normally like 4 to 5. The fact that this is 1.13 is crazy.
That's very under.
And the price to book, they're generally like 6, 7, 8 in the tech area. So the 3.24 is a really good.
That's really good. And then if you look at current price of almost $15 and average of 20.
So this one, I could see this one being a 50 to 60% gainer in the next couple of years. That's
plus
why
a 5% yield, strong buy. Yeah, I concur with that assessment.
We have
it.
Yeah. Next one is a Canadian energy company. I know everyone.
CNQ sounds Canadian.
I know everyone hates Canada right now, but like whatever. Get over your personal issues with the Canadian.
No biases in finance.
Because this one is actually really good, other than its EPS growth.
Negative 24%.
But I think they wrote off some purchases and things of that nature, like because the EPS prior to 23 to 24 was not near that. I think it was like 2 or 3%.
Oh, so very nice.
But it has a decent, like for a utility company, a 7% or 6.4% projected growth is pretty high. Again, you have to know like what you're dealing with when you're looking at stocks. Like utility companies are generally like 2 to 3%, so that's like double what most utility companies are. The pegs of utility companies are generally 2.5, 3, 3.5. So again, it's undervalued compared to its peers. Price to book it's undervalued compared to its peers, and you're looking at what is that? 10 divided by 27 is 33%. Plus, you're getting the 6% yield.
6% yield. Strong buy.
Strong buy.
A.
Go Canada.
Go Canada. Hoser. Is it Hosers?
Yeah.
What was it from?
Hoser.
Nice.
FMC is a wait.
Okay.
The price to book's
2 red flags.
Really high, and its EPS growth.
Oh my God! Price to book 7.4. Yeah, I think that might be. Oh no, we got one more that's higher than that one.
But like,
negative 71%.
I could see the potential for it because it's 6% yield plus you're getting
$37 current average
like
projected
25%
target
price
of
gain.
50ish.
But there's that negative 71.
Yeah.
And it wasn't like a write-off. I couldn't find anything in the financials or
the news okay, so that's even like bigger red flag.
Why their EPS would have been down that much.
So yes, I concur with the weight assessment.
OGN we actually hold in her mom's retirement account.
So that's the medical one with the female.
But the reason I got into this one, before I even knew what I was looking for, I just looked at the price to earnings. You see it's like 2.9 and 3.3, and you see like an industry average is 34.
Oh my God, that's huge difference. And when we were getting rid of Pfizer, this was the one we like scooted into.
And the EPS in this one is because they actually did some research and development, so it's all good.
So that makes sense.
The projected growth not that great at 3.8. It should be like in the 6 to 7 range. But the PEG's good. The price to book should be in the 5 to 6 range. So there's a couple
6.9.
A couple things that are like causing like, oh, what do I do here? Because like our EPS growth is down a little bit, and it seems a little overvalued with the price to book. But then when you look at the price to earnings, but then you look at
yield,
it's going to double in price. Plus it has a 10% yield. Like to me, it's a buy. Just based on the fact that like your potential for 80% gain is there. And like this one was like last year trading at like $25. So this one is.
And it's at 11 right now.
Yeah. So if you haven't bought it, I would buy it. If you have it, I would just keep putting money into it. Drip. Next one is an energy company.
Oh my God, you're the new Kramer. Instead of buy, it's drip.
Drip. This is a strong buy. This energy company actually had a lawsuit. That's why the earnings per share went down.
That's a big
50%. But every other number is super awesome. Plus you're doubling your price.
Yep, doubling
and
price.
you're getting
8%. That's really good.
For an energy company, 8% yield's insane.
Do you actually put that in a strong buy? Yeah, you're right. Utility energy, that's usually like 4 or 5%.
Yeah, 3 to 4 or 5.
So eight's a doozy.
That's crazy. M&R is one that I have in her dad's account for some reason. I don't remember why I got it, but
my dad has like nothing in his
I saw
account.
someone ask a question about it, and I looked it up, and like it's shit. So I probably have to get out of it. The yield's really high. And it has potential to double in share price, but
20%
like
yield.
But this one to me screams like yield trap. If you're not familiar with what a yield trap is, that's when you have a high yield and you put money into it, and then the price goes straight down. Like a lot of people will classify like yield maxes as yield traps because you're getting like 30, 40, 50, 60% yield, but then the price, like the NAV price, just keeps deteriorating.
Yeah, but if this is a stock,
where I can see like
this isn't like options trading. So I hear you on that one. So you have that as a weight.
Yeah, well, that's don't get into it.
This will be a question mark.
This one, no. And then T Rowe, I got a couple questions about, and actually
T Rowe.
They actually in the Sure Dividend newsletter recommend this was I think their number 8 investment for the month.
That's really good PE versus industry.
It is
10 to 17.
But you look at the PEG and the price to book, they're super high compared to the financial average. And you're only getting $7 price appreciation, which is like 7%, plus you're only getting a 5% yield, so you're only making 12%. for something that could go down to get that number back in the 1 to 1.1 to 1.3 range and get that number back in the 1.4 to 1.6 range. So I actually think the depreciation in this one could actually counteract the dividend yield.
And it's a higher priced one. So it's like currently at 88, and we always feel some kind of way about that. So unless it's like greens across the board, Tim has this one in the weight category, and the yield's not that much.
The next one actually was
no T-row.
They had a discussion in Reddit about Wendy's. They said, what's the best fast food one to get? Because a lot of people expect fast food to explode because people they don't want to go to the store and they don't want to cook, and they're all depressed because everything costs more. Wendy's is okay other than the price to book, which is insane.
Oh, yeah. So we were talking about that other one being the highest. Wendy's has the highest, 11.19. That is biggest one on the list. So this here is at that point, that is a risk versus reward, because you see the Wendy's, the price projection is 5. So that's like 33% plus a 7% yield. So you're looking at like a 40% potential gain for something that I could see going down in price. Yeah, I don't know if that's
so. Would it drop 40%? Probably not. But there's there's way better investments on the list that you could dump money into to get a yield on. So
yeah, just because you think fast food's going to go up doesn't mean that there's good stocks to invest in. So when there's other options. I would put it in other stuff. And then the last one is one of my favorite utility stocks. ES. And you'll see. Red flags. You'll see how my mind works right now. Here we go. There's red flags everywhere on this. When you see the current PE is way above where it should be. But you see its forward-looking PE is way below where everyone else is. That doesn't even make sense, but okay. You'll see that its EPS growth is ridiculous. And you'll see its projected growth is pretty nice. But you'll see its PEG is way high for a utility stock. And you'll see its price to book is about average for utility stock. So like he's looking at it's overvalued based on its current price to earnings, and it's overvalued on its price to earnings versus price to earnings with its growth included. So you have two overvalued things, but you look at what they're projecting this one. They're projecting this one to grow. Is that 17? So 20-some%, you got a 5% yield for something that is a dividend. It keeps growing its dividend every year. And it's utilities. So 5% for utilities, about average. But I have it as a weight for all you people that aren't in it. But to me, that average price, 69, is way low. It should be like they should inverse the first two numbers. It should be 96. Oh, okay. So you're actually saying that should be higher. So that's why you would buy it now. Why I bought it was because I expect it to double in price with like a 4 to 5% yield. And why you are probably reinvesting like a mofo would be my guess. So they're like I said, this is just like my emails I get during the week, and then questions on Reddit and questions on the YouTube videos and things of that nature. I just went through like some of the stocks that people have brought up, and I came up with that list of evaluation. The reason that we went through the first part is to show you how to evaluate stuff based on the metrics that I look at, so that you could do it if there's stocks that weren't on the list that you're curious about. So you can plug it into Schwab. If you have to create a Schwab account, I know it sucks, but to me, Schwab is the best research thing, because it's all like you saw. The price to book is there, the price to earnings is there, the future price to earnings is there, the revenue and the debt charts, are all there. The charts that Schwab has are it's just so much easier because all the information's right there. And then if you go into Yahoo Finance and you just plug the ticker in, and then you click on the analysis tab, you can then go look at what the experts are saying, what it should cost or what it will cost in 12 months time. Then you can see what the experts think the growth is for the upcoming year, and then you can create your own spreadsheet, your own watch list, and then you can say, well, then you can do your little thing, like, is this worth a buy? Again, it's all risk versus reward, and the more information that you have. Who said that? Peter Lynch said the more stones you turn over. So you just keep researching, keep plugging away, and you'll actually have a watch list of like all strong buys that you can then say, oh, well, I have money, so let me just buy one. Either when you get money or when stuff actually drops right into your buy range. I'm not saying what I do is right, but it works for us, and it works for people that trust me to give them information or actually help with their portfolios. Yeah. You might have a different risk versus reward equation than I do. To me, I'd rather if I can make 30% on something that could go down 10%. To me, that is a risk versus reward. And you can get so far in the weeds on equations, like you can literally get so complicated, and it's not. Our experience has just been it's not worth getting that far into the weeds on stuff. So you have to think. Generally speaking, the markets go up. Long run.
Okay, up. Long run, they go up. So the price, like all those valuation metrics are just a moment in time. But if you see that the price that you currently are paying for is like half of what it should be, and you got like a 6 or 7% yield, even if it goes down, you're still making money on the price appreciation in the long run. Plus, you're getting that yield all the time. So you just then at that point you just turn the drip on and just collect shares. And like, I was doing at the end of March, I did the spreadsheet for the van lifers that follow, and we actually did a podcast with them as F&A, and I couldn't believe just some of the like share quantities that she had. It was insane. Just because I left the drip on, even though the markets are going down, her cost basis is going down because sometimes the drips are on, sometimes the drips are off. But she has like thousands of shares when she only had like hundreds of shares before like this all started when we started doing it.
Yeah,
so, like,
drip is powerful, especially when the markets are going down. It's one of the best things.
Like she's the one that like I'm super jealous of because we only have like 300 shares of Hercules. She has like 1,000 shares of Hercules.
We'll get there one day.
It's insane. And then she has her mom's account's another one. Like I telling her we went for a walk earlier, and I told her like one of the first investments I got her mother into was XYLD because it was a covered call S&P thing, and she's just collected dividends and reinvested it for 4 years now, and she has like $20-some thousand in this stock that she only had. Like I only put $8,000 in.
Oh my god, that's crazy.
I don't understand. Like it's gone down too. You know what I'm saying? So like if you like. The yield plus
we should do a case study on that
plus
one.
The price appreciation or depreciation plus your risk appetite determines that equation. And the fact that she's grown from, she has damn near like 800 and some shares of XYLD when I only bought like 300.
That's awesome.
She's almost like 200% up in share quantity.
That's awesome. So the whole reason we wanted to do this was because the markets are plummeting. Most of the down is in, and we wanted to give you guys a list of stuff. Well,
the first part, I wanted you to learn how to do it yourself.
Yeah, that too.
But then there are on that list, there are like 6 or 7 that are strong buys that are if I had money, I would put money into them right now because they had like all the valuation metrics are pretty sick. And yeah, then you're literally just, if it goes down, so be it. Just put more money into it because you know they're going to go up. And when they go up, they're going to go up a lot based on their valuation metrics. Next week, I haven't came up with an idea. I have no idea. I have to write the email for next week.
Oh, so we have no idea for next week.
No.
So it's going to be a surprise.
Yeah, like I did this. This took a lot of time because I went through hundreds of stocks. And
I'm sure you'll come up with something fun, or something will come out in the news because it's back and forth.
Yeah. So like next week, I don't know what it'll be. It'll be something. It'll be something cool. Something cool.
All right, guys. Hopefully that helps you get some money into the stock market.
And if you have any questions about like anything, just
drop a comment,
and I can walk you through like how to do your own evaluations. That like it's like the most important part of anything you're going to do with this investing is making sure you're getting stuff that's undervalued so that you're not paying too much. You don't care about the price, like you don't care about your brokerage account principal, but you don't want to overpay for something when it's going like.
You want that safety margin.
Say you get into something that's yielding 7%, and you're like, oh, that's a pretty tight yield of 7%, but like it goes down right away. Yeah, like a lot.
That's very deflating. So if you can get that extra safety buffer in, that'll
because you got like 100 shares at $7, but had you waited till it went down to like where it was supposed to be, you could have got 200 shares at like 10%.
Word of the wise.
It's the most important thing is valuation. That's why we've had so many podcasts about it.
Dividend investing / value investing for the win.
Drip, drip, drip.
Drip, drip, drip. Oh my God, it sounds like chlamydia.
Fuck Kramer. Jim Cramer's the worst.
All right, see you guys next week.